Before you take that loan, watch this. Because the decision you're about to make might not just cost you money. It might cost you time. And time is more expensive than interest. Most people don't think deeply before taking a loan. They think, can I afford the monthly payment? That's the trap. Loans are not sold based on total cost. They're sold based on monthly affordability. And that small shift in focus changes everything. Let's say you want to borrow $20,000. The bank doesn't start by saying, you'll pay back $27,000. They say, it's only $430 per month. $430 sounds manageable, but over 5 years, you've paid thousands in interest. And what did you really buy? Not just a car, not just furniture, not just a lifestyle upgrade. You bought delayed freedom. Here's how loans actually work. When you borrow money, you're pulling future income into the present. You're spending tomorrow's effort today. That means part of your future paycheck is already spoken for before you've even earned it. Now imagine stacking multiple loans. Car payment, credit cards, personal loan, maybe student debt. Each one looks manageable on its own, but together, they quietly reduce your flexibility. And flexibility is wealth. When your income is already committed to payments, you lose options. You can't easily take career risks, start a business, move cities, reduce hours, or handle emergencies. Because your future income isn't fully yours. It belongs to lenders. Now, let's talk about interest. Interest is the price of impatience. If you invest money, compound interest works for you. If you borrow money, compound interest works against you. And it works quietly. At first, interest feels small. But over time, it multiplies, especially with credit cards. Minimum payments are designed to stretch debt. You feel relief because the number is low. But low payments mean long timelines, and long timelines mean more interest. Now here's the psychological part. Loans feel good at the beginning. You get the car. You get the upgrade. You saw the problem immediately. That emotional relief is powerful. But the pain is delayed. And humans consistently underestimate delayed pain. That's why loans are so common. They separate pleasure from consequence. You enjoy now. You pay later. But here's something most people never calculate. Opportunity cost. If that $430 monthly payment was invested instead, over 5 years, over 10 years, what would it become? Loans don't just cost interest. They cost misgrowth. They cost momentum. Now, are all loans bad? No. Some loans can increase your earning power, like education that increases income, business capital that generates profit, or strategic real estate investments. But even then, the loan should create more cash flow than it consumes. If the debt doesn't increase income, it decreases freedom. There's also risk. When you borrow money, you're betting on your future stability. You're assuming your job will stay secure, your income won't drop, and emergencies won't happen. But life doesn't guarantee stability, and fixed payments don't disappear when income drops. That's when debt becomes stress, and financial stress spreads into everything: relationships, health, decisions. So before you take that loan, ask yourself 3 questions. Is this a need or a want? Will this debt increase my income or decrease my flexibility? Am I buying convenience or buying pressure? Because loans don't just change your bank balance. They change your behavior. When your income is committed, you make safer decisions. You tolerate more. You risk less. You stay stuck longer. Debt reduces negotiating power, and negotiating power is financial strength. Here's a simple rule. If the loan buys something that goes down in value and doesn't increase your income, be extremely cautious, because you're financing depreciation and paying interest on something losing value. That's double loss. Now imagine the opposite. No car payment, no credit card balance, no personal loans. Your income flows to you. You can invest. You can save aggressively. You can take risks. You can pivot quickly. That's power. The wealthy don't avoid debt because they fear it. They use it strategically, and they avoid consumer debt that locks future income. Before you take that loan, zoom out. Picture your life 3 years from now. Will this payment feel light or will it feel heavy? Because financial decisions compound. Small monthly payments turn into long-term commitments, and long-term commitments shape your life. Debt isn't evil, but it is binding, and every binding decision should be made with clarity. So before you sign anything, ask yourself, am I buying something or am I selling pieces of my future? Understand the system. Master the mechanics. Build real wealth.